Thank you, and good to see so many of you here rather than planning your next holiday at the Natas Fair or getting your skin burned at the golf course as well. Probably better off here, aircon, and you go home, I think, feeling perhaps richer as well after you sign on to Mr. Lee, a new service. I suppose that's really an important tool that's probably you will continue to have to use, because I don't expect the government to make any U-turn currently on financial prudence. So, do you get to go? I don't get any commission for selling the plug as well. I just plug the macro environment, which is also an important consideration on whether you think global interest rate is going to start turning, or maybe you have another year or so of flexibility on the interest rate front. So what I'll do before we get down to the implication and impact on, say, local property or perhaps even around, I'll just take a sort of a helicopter view of how we see the global economy is likely to pan out over the coming year, and to what extent that may shape Singapore's growth as well. So let's begin. In Singapore, we have to have disclaimer one, so otherwise MAS throw me in jail for... Okay, outlook, I suppose so far, okay. Singapore, I suppose that's small, 716 square kilometers. If the global economy isn't feeling firm enough, we will feel the chill. We will certainly see a lot more empty boxes stacking up on the ports at Tanjong Pagar, or the airport being a lot less busy as well. So far, so good. And the ports still very busy. This is what I normally look at. In Singapore, we are among the busiest port in the world. Us in Singapore, Hong Kong, and obviously Shanghai, which is the #1 port. So that's the aggregate number on the top over there. Nothing that great. Things seems to be holding steady in terms of the volume being moved. Bottom chart on there, you see how busy Changi Airport is. We are going to handle something like 1,000 flights at the airport very soon, which is why the government is now planning ahead in terms of adding more terminal, more runway and terminal as well. So in the coming years, Singapore will continue to benefit from rising visitor arrivals, etc. as well. Although at this juncture, most of the new arrivals in terms of the flights handled are the low-cost carrier itself. We have seen how many planes the Indonesians are planning to add to their fleet, etc. as well. Nonetheless, what you see on aggregate, the other purple charts is the end consumer. That's the cargo handle at the 5 busiest US ports itself. So as you can see, Americans are a little bit more confident. Maybe the last 2 months they have their balls frozen off, but nonetheless, beyond that, they should still, I would say, after that, pick up and then spring along as well. So in summary, what you see from this chart is just, okay, nothing too great in terms of the volume of growth, which is why in terms of what we see in government projecting the growth for the year, 2 to 4%, which is, I suppose, what last year had, about 4% growth itself, because numbers are okay, but not that brilliant at this juncture. And what we do look at in terms of, if there's one number that you want to take a look at while you're property hunting, is the monthly, they call it the Purchasing Manager Indices. Globally, they start to be released towards the end of the month, as well as the first week of the month. Today, this morning, we had the Chinese PMI numbers. PMI, for those who are not familiar, is really just a survey of business. It's just like me taking a survey, say, if of this room itself, if more than half of people in this room say you're busier, then the index will be above 50. If more than half of you say, wow, very senang, the reading will be below 50. In that case, it's just a case, therefore, we call this technically diffusion index, whether more people are more confident about their outlook because there are more orders on hand, factory floors are more busy, above 50 itself. So as you can see from here, generally the last few months of last year, beginning of this year, above 50 generally, but not a lot so. This morning we had the Chinese one, which is just barely above 50. We had the Chinese number barely above 50 for January and February. But obviously we know that Chinese New Year falls in the early part of the year, and as a result, you do see fallback in orders, you do see fallback in production activities as well. So while we have seen the Chinese number pull back, we're also mindful that there may be circumstances that contributed to that moderation. Similarly, so American activities were also softer as well. There we blame the winter, the more severe rain, snowfall, etc., as affecting economic activities. So we'll see that whether this distortion, whether it's weather-related or whether it's festivity related, it's still with us to stay once the first quarter is over. So the bottom line here is numbers in the first quarter will be choppy, but as long as the numbers are choppy, not with a significant downside or basically downside risk, I think we should be okay in terms of the overall macro numbers as well itself. Because the bottom line here is for Singapore, trade is 3 times the size of our GDP in goods and services itself. So if demand for our goods and services don't pick up, we won't get to see the macro numbers improve significantly in terms of GDP, in terms of, I suppose, the level of activities on the ground itself. So essentially, if you see the numbers starting to head higher, you will probably only see that from March onward. Yes, we will get a technical rebound. The Chinese PMI numbers normally rebound quite sharply in March. That is expected. If we don't see that, you might want to sort of slow down your property hunting first. But if it continues, then I think just carry on, whether in this side of the causeway or the opposite side as well. Because the bottom line here, macro environment externally, it is not getting worse. It is slowly improving. Obviously, it's sputtering a little bit here and there. The top chart here is just indexing the GDP level to 2008 equal to 100, basically pre-crisis or pre-recession level. As you can see, the US one, the blue bars, has recovered much better than the red bars. That is the European economy. European economies, by and large, are still below their pre-crisis levels. But as you can see from the direction of the red bars over there, it's getting less bad. It's now only getting back to the level of 2008 itself, which is why the unemployment rates over in Eurozone continue to be the main drag on overall growth. But it's getting less bad. American side, a bit more busier. Businesses are hiring in greater numbers, although we haven't really recovered the full numbers just yet. Because if you remember, in the 2008-2009 recession, the US economy lost something like 8.8 million jobs. So far, we haven't recovered that one. We have just recovered somewhere around just under 8 million jobs. So, which is why, given the fact that businesses are failing in fewer numbers, jobs are being created, the US Federal Reserve, the central bank, says, okay, the economy needs less, morphine to stir it into life. We are slowly taking more money out of the economy itself because businesses, the private sector, are more confident in standing on their own feet. So as a result of which, we have seen, the economy on a much more stable footing. And this perhaps is a good example of that. The bar chart just shows how many banks, American banks, were taken over by the Federal Depository Insurance Scheme, basically taken over by the Zhenghu. So as you can see from the chart itself, for those far enough, 2013, only 24 banks were taken over versus 51 in 2012 itself. Businesses, nonetheless, are still failing, which is why this year, 3 banks are taken over, far fewer as well. The bottom line is probably more relevant. That is the property market in the US, going all the way back to 1959. So as you can see, we never had that kind of correction in 2008, 2009, that sharp plunge down in terms of housing starts. Only now we are starting to see it creeped up as well. So those of you still who are more adventurous and want to look beyond Singapore or the regional shores, I think US still presents a very, interesting markets for you to take a look at as well, against the backdrop of macro recovery, job recovery, business recovery as well, because the recovery in the housing is just gradually underway. I make it a very long trend line there, basically just to illustrate that there are plenty of noises on them. These are monthly data, month to month as well. The last 2 months, obviously, we had severe winter when people are just staying at home rather than going out there, either building homes or looking for homes or going to think of hunting for homes as well. So that has affected the numbers somewhat, but nonetheless, I think if the underlying trend continue, i.e., private sector businesses continue to ride on the recovery, hiring more people, people will spend, and they will start to basically give that lift to the economy itself. US, as you can see, slightly better shape. Europe, I think, is also, in a slightly better position now. Obviously, when you have huge unemployment that varies significantly in levels across the whole zone itself, it will have different and patchy recovery by and large itself. This chart is just basically showing you cost of borrowing in Europe. When there were more uncertain period, the cost goes up itself. A bit more confidence. Last week, we just had another change of the Italian government. In the past, any hint of change of Italian government will cause nervousness in financial center that will ripple around the world. So far, it seems to be taken in stride. That last Italian government only lasted 10 months. New one coming, it seems to be, again, okay, we have another change in government, but not as risky for the Eurozone as we think previously as well. So that's encouraging in terms of what this charts here have to say, in that financial markets are less worried about Europe. That's also good, but sometimes also worry me as well, in that we might become too complacent in terms of the European recovery. We may be taking too much for granted in that, the high level of unemployment, which is like still 30%, 40% in places like Greece or even Italy itself or Portugal, could still undermine the recovery if our people are still very unhappy about the slow recovery that they're seeing itself. So, but nonetheless, if you take the previous chart to now, it does show that developed economies, US, Eurozone, are in a much better shape now. China, well, we always have fun trying to interpret Chinese numbers itself. It is lots of data that are coming out or can come out or basically due to be released as well. My only, I suppose, things I could say about this is, for policy planner in the Chinese landscape, it's really about trying to ensure stable, sustainable growth. They can't sustain the more than 10 or 14% growth of the last 20 years itself. What we have to see now is quality growth. Now, to slow economy, which is going at double-digit growth, to a mid to high single-digit growth, obviously will have consequences. You will have business failures, because if you don't, that's not about restructuring itself. When you restructure, when you slow down, you will have consequences. You will have business failure, as businesses, say in the mining industry, etc., are being consolidated as well. So the best thing to do that, obviously, has to occur against the backdrop of a macro environment which is still growing steadily. Because when you tighten credit, obviously some will feel it more than the others, and some could potentially turn to become non-performing loans. For those at the margins, we may not be quite NPL yet. They just want to make sure that there's sufficient but slower growth that allows company cash flow to continue. So as long as you maintain your payment, banks will say, okay, good enough. We will try to, in a medium term, look at ways to restructure your debt, etc. But as long as you continue to just service your loan, for instance, that's fine. So that's the whole idea behind what's happening in China itself. We know that there is an issue with local shadow banking, i.e. for those that don't formally or cannot formally borrow from the banking system itself, they go so-called the underground to borrow, obviously at higher rates. And it was quite lucrative for a while because of the tightening in credit. But once credit are tightened, even funding for the so-called shadow banking are also being affected as well. So it is now the process of steady consolidation that is more important at this juncture. We know there is an issue, and it will become a much more serious issue if we have an external shock. For instance, say Europe, for whatever reason, double dip, and then we cause another round of global slowdown again. Yes, it could potentially blow up the offshore banking problem in China than what we're seeing right now. But for now, we think it is manageable as far as looking at the numbers are concerned. I look at things like cargo that is being moved through ports, seaports, etc. So far, I think it looks okay. Machine tools, imports and uses of machine tools. Yes, machine tools are made to use, well, whatever, fake milk powder, fake eggs, but also proper stuff like real lights as well. It creates real jobs and create real income. And real income, I suppose nominal income is on the rise. We in Asia or Singapore here, businesses in particular complain about rising costs because of wages. In China, nominal wage 1,400 RMB per month. According to their law, they're supposed to be going up by 10 to 15% annually going forward as well. So as you can see, we're not just facing problems in terms of rising wage costs here in Singapore, but around the region, and including China as well. Obviously, the longer run is this support consumption and spending, and therefore provide domestic growth engine as a stronger contributor to the Chinese growth than what it is currently, which is about investment as well. So Japan, well, so far quite good news in terms of the numbers heading in the right direction, inflation starting to creep back into the economy itself, and I'm thinking perhaps with the introduction of the higher consumption tax come April, with that lift, anytime you raise consumption tax, confirm you'll be a rise in inflation as they pass through the economy itself. Now, obviously, if the mindset in the Japanese is, we are now seeing inflation here to stay, then perhaps we also should start to also spend. Because in the past, no need, because everything costs the same whether you spend today, tomorrow, or next year. But now, if you have a threat of inflation coming through, there is that hint that perhaps you should start to spend, because at least on the ground, they're seeing more prospect of recovery. This is a few of them in terms of factories being busier, the top one, the PMI. Visitor arrivals had climbed up, but had leveled off over the second half of last year. That's more due to fewer Chinese turning up in Tokyo, mainly because of the squabble of who owns and who call what islands, what name as well. But interestingly, arrivals from around the region to Japan has gone up. I'm sure many of you have been to Hokkaido or Tokyo over the weekend. I'm still planning to go to Japan soon as well, because the exchange rate is attractive. I'm still a Malaysian. I hold a Malaysian passport. It's only from July last year, for those of you who are Malaysian in this crowd here, who realize you go to Japan, no need visa anymore, as long as you're biometric passport, jump on the plane, turn up at Tokyo airport, happy like a bird. And many have done that as well. So these are the little changes which I think the administration is carrying through, which I think will be supportive of their sort of a gradual recovery, and which hopefully will continue to show up in the Japanese numbers as well. Now, conclusion, obviously, as we've seen from the few charts above, I think fairly steady, nothing spectacular at this juncture from around the region or around Europe as well. And that should be hopefully sufficient to support our recovery on a modest pace going forward as well. These are our numbers. Nothing too spectacular in terms of the forecasts, etc. Now, coming back to Singapore itself, against that backdrop, I mean, if the region and the world is in a steady state on that modest recovery, obviously we have risks. We know that anything could still happen in the South China Sea, in the East Sea, or whatever name they want to call it. If somebody miscalculate or have a misstep between China, Japan, North Korea, South Korea, even down to the Philippines, on whether they want or happy about incursion, exclusion, whether your boats or your plane are in my territory or your territory. All these are still issues which potentially could create some heightened geopolitical risk. But outside of that, I think it's okay. The other one that perhaps is worth highlighting is also the weather as well. So far, inflation generally isn't a big issue over the last couple of years. But as you can see from our Singapore here, weather has been very strange, has been exceptionally cool. I haven't turned on my home aircon since December. I don't know whether it's still working or not. But the good thing is my bill is very cheap now, so I suppose that's the plus side. But what it may mean also is that the period of the strange weather could lead to drought, as we're seeing, Singapore green city become brown now. In terms of the commodity prices, that could pressure commodity prices and inflation going forward. So that's just one thing that perhaps is worth following in terms of the weather as well. Now, coming back to Singapore, pretty straightforward. I think the good thing about now is, businesses still complain about higher cost of doing business, either in the form of rentals or in terms of wages. What it also means is that businesses still have many opportunities to set up or expand or whatever you want to do in Singapore itself. Because the flip side is, if you complain about higher costs and higher rentals and higher wages, but that is the worst part. But the thing now is, these are the charts which we basically summarize where, this is business formation over the last few years itself. Some industry obviously better than the others. The other bottom one which has trend down, that is in the real estate side, obviously ever since the government tightened up, lending and taken some of the bubbles out from the property market here. We're starting to see that those businesses which are set up related to real estate has come off. But beyond that, if you look at it in terms of transport, logistics, in terms of Infocom, etc., it has done relatively well. At the bottom right there, I may not see it at the back, it is about the number of petitions for bankruptcies as well. Leveling off, which basically suggests that things are, quite okay in terms of the pace of economic activities, in terms of pressure from costs itself, in that yes, it had led to more businesses to fail, but also more have set up as well, but the overall number still remains fairly stable. But what it all ends up with in an environment where there is growth opportunity for businesses, and on the supply side, a huge supply crunch in terms of foreign labor, you got pressure on wages. This is a full employment economy itself. Unemployment rate, depending on whether you're a resident or citizens, is still at record low itself. There are more vacancies available than people looking for work, which is the bottom chart in terms of the ratio of job vacancy to the number of unemployed people looking for the work itself. And the top one is in terms of job creation. The gray bar is new creation of foreign workers itself. These exclude maids and exclude construction workers. So as you can see, once the supply has tightened up, it is really businesses having to rely more on resident pool of workers, the pink stripe bars, as you can see, going up as well. But again, to get the resident to work and to get them to join the labor force means wages has to go up, and obviously that's on the cost side as well. So this has plus and minuses depending on where you are, and primarily because the supply of labor, in particular foreign labor, the top bar, as you can see, very strong growth between at the early 2001 onwards. It coincides obviously with the completion of Marina Bay Sands, the work at Sentosa, etc. as well, with all these hotels and that needs to be opened up. You need to hire more workers, and since then, obviously the political backlash, I think, has led the government to basically tighten up quite significantly. So we are, in that sense, both sides back down to very low level of foreign labor growth already. Flip side of this chart, in terms of full employment and higher participation rate from the local labor force, is obviously wages go back, and that's what we see in terms of the bottom chart. This is basically the percent share of the total employed resident, the residential pool, local resident pool of wages. Yes, the bottom line, pink one, number of share of people earning more than $10,000 a month, slowly going up. Those earning less than $2,000 has been slowly coming down itself. So everybody feel wealthier. So that's obviously when you feel wealthier, you also borrow more at the same time as well. So that's the flip side, which is why so many the three pawnbroker has set up plenty of shops all over the island as well. So so this is mainly because of this one. In terms more people with more money, so more money means more to borrow as well. So in terms of full employment, low interest rate at this moment, what does that mean on the overall property market? End of the day, you don't need me to tell you. Singapore only that big, as I say, 716 square kilometers itself. Population growth, roughly about 1 million every decade over the last 3 decades itself. Going forward, okay, supply have been tightened. May not be 1 million every decade. Perhaps it might be every 15 years. But nonetheless, population growth is still ongoing, so it will still add more people to the islands itself. So to me, it's as long as the underlying property prices, the top one, returns to that trend, that red line over there. I think Mabautan wasn't able to do that. Koh Bun Wan hopefully can do that itself. But in terms of the underlying fundamental, you have firmer wages that will be supporting that recovery itself. Now, in terms of why I think the government introduced the total, the TSR framework is really the other two line charts that you can see over there. This is the top one, household sector liabilities, basically mortgages, as a percentage of the GDP. You can do it as a percentage of your income as well. It has started moving up after 2007, 2008 itself. It was much higher. So in that sense, Singapore policy planners were fairly prudent. They didn't want to immediately tighten, funding or access to borrowing too early. They want to tighten it, like you can see now, halfway between, the previous peak, which is, I think, the right thing to do, because what we might see going forward is that, interest rate, which had been low for the last 5 years, may not so low. It may have another year or two to go before interest rate turn, but it will nonetheless turn. And with 75% of total mortgage housing loan pegged to floating rates, it will have impact on affordability and your borrowing, etc. as well. So household debt as percentage of GDP, that's the bottom one. Similar kind of picture. It is going up because of the higher borrowing, but it's not what has been, painted as by some articles of Singapore heading down the road like Iceland, etc. as well. We are nowhere in that direction itself. But we are mindful that, if excesses were allowed to carry through, it potentially could sort of put a risk in terms of the whole property itself. Now, coming up just to the budget, to wrap up in terms of what it means, obviously the good news from the budget standpoint is there's no other measures, but at the same time, there were also no budget relaxation measures as well. Don't rely on the budget for all these kind of announcements now. The government can and probably will tweak measures anytime when they see fit. If they started to see that the adjustment in the in the property market has accelerating or have accelerated to a level which they are more comfortable with, they could relax. So it won't be in the budget. If it timed such in the budget, it will be, but I think a lot of these will probably happen outside of budget time itself. But for, I suppose, what we see in terms of the budget itself, nothing really that relevant to the overall property market itself. What it does is much for the budget now for the coming few years is all about aiming for restructuring for the next, say, 50 years. The last 50 years is really about building Singapore from a country with no resources, except people with the energy, to what it is today, a very successful and very competitive economy because of the very attractive investment landscape, etc. as well. So budget announcement were all about helping company get economy to this stage. Now, going forward, a company will still need help in terms of adjustment to get them more productive to deal with the pressure of fewer or the slower growth in supply of foreign workers itself. But it's also about helping, I think, the community by and large to deal with the fact that it is aging, healthcare costs become more important, education quality will be the main point itself. In terms of funding, Singapore government, not an issue. It presents its annual budget in the most conservative of manners. I would say that. Those in the back may not be able to see it. But normally, be it Malaysia, Indonesia, or any other countries, budget presentation is presented as total revenue collected from taxes, from land sales, etc., and then net off total spending, be it for paying ministers' salary, to running a government, to development expenditure. What's left? Budget surplus or budget deficit. In Singapore, all spending are net off against operating level, the tax itself only, which is the top here. Basically, most of it from the IRAS tax collection. Last year's total revenue was about, for those who can see, about 57 billion. Last year's IRAS collection was about just over 50 billion itself, taxes. From two sources, income tax, which is about 42% of that, as well as GST, which is about 18%. Then the rest like stamp duty, property tax, vehicle tax as well. So as you can see, all spending can be funded just from taxes alone itself. So don't be afraid. Minister come around and say, don't bluff me. I know you got money one. Bottom chart shows how much. If we were to present the government budget in a so-called cash flow, including capital receipt, last year's surplus was about 25, what was it? About more than $20 billion. So got money one. In terms of the Pioneer package, etc., for those who are not familiar, Singapore, the government, when they call an election, whatever surplus of balance for the year is then sort of capped. Then the new government, same people actually, will start with a clean sheet itself. This government, actually same people, 2 years in power already. The surpluses, as you can see from the 2012 and FY 2012 at 13, almost 5.6 plus 3.9, almost 10 billion. So that 8 billion of Pioneer Package Fund already funded already, which is why, in that sense, it's quite smart politically for them to say, okay, I kept that surplus, part of that, as, you know, spending for the lifetime of the Pioneer batch, which is, I think, good, because what it means also is further down the road, just in case they lose more than just our unit or, you know, the government of the day still have the money in terms of paying. So I think that is politically a smart move. I think economically also as well, because it allows you to then deal with other issues from other fundings and sources as well. So in a nutshell, we would basically say, you know, the budget 14, I think it's really about tweaking the economy for the longer run itself, in terms of making sure that healthcare, which will become more and more important as aging profile changes, is about CPF or citizens or Singaporean being able to afford healthcare from their own. Remember, my generation, your father's generation, is about us helping our parents. Future generation is about helping themselves, not depending on, you know, unlike the American who has a very huge debt, they have to depend on their children to pay for that one. So all these are issues which I think the government here is thinking of on a longer run. I sound like a PAP man, but I'm not, seriously, I tell you. But so, and the bottom line really is what it all means ultimately when you come back to the theme for today in terms of, say, property, in that you do have a much more planned economy where you have greater stability. So what that means to you in terms of investment horizon really is you have greater comfort in terms of, let's say, using the tool that Mr. Lee was talking about in planning going forward. You don't have to be afraid of just, if interest rates turn 1% or 2%, lu chuat si. It's not really, I think, that backdrop you have to look at itself. So that means it gives you greater certainty in terms of the underlying structure of the population and the property cycle itself. Being from CIMB Bank and from the equity side, obviously I have to end up less about the property. Unless you want to borrow money, come look for us at CIMB Bank. And if you want to buy stocks and shares, also come look for us as well. So in terms of the broader implication, really is for businesses, yes, we do see higher costs, and that will probably impact in terms of when the CPF are adjusted next year onward as well. Hopefully by then, some degree of help through pushing them to be more productive can help, although in terms of the more labor-intensive sectors, your developer, your construction sector guys, it may not mean that much, but it will mean still costs going up. But I think by then, those boys are more effective in terms of using their labor itself. For the property developer themselves, I think the good thing is, for those who are longer term, all the stock prices, I think, are very attractive in terms of valuation standpoint. Not in terms of whether they're going to sell a lot more property, more on the valuation standpoint. So again, it's looking at physical property with a longer run. If you look at them in terms of a longer run, this developer as well, it's probably worth consideration, because they will be around for a long, long time, these guys over there. It's all about timing themselves for their property land banks, etc. as well. So the current kind of valuation, very attractive for those of you, who wants to take a longer view, especially in this environment where the market is relatively quiet itself. So, we do have some, notes in terms of the property sector. After that, sing and song and dance, our overall call is still neutral as far as the various sectors of the property segment itself. The only one we may still see some sign of life, mainly because of supply constraint, is property sector, Shenton, where the rentals are still, inching up, although we do see supply coming on, but not so soon itself. I think landlord over there can still enjoy, rental gains for the near terms as well. REITs, I think, is still there, even though interest rate risk remains. I think we're probably still a year out, for instance, as well. So, but obviously, in terms of the underlying market itself, I'll leave you with this chart. The top one just essentially show you in terms of the physical supply itself and the vacancy rate that we do see. So, which is why I think every analyst in town, even the boss of DBS himself was saying, price correction, yes, likely 10 to 15%, probably, we will see. A lot will really depends on the underlying market condition, whether the global economy has picked up pace, whether we have returned to 5% global growth or we are still running around 3%. If we are running at 3% still, then probably prices generally will not be, or will probably correct more. If the global economy is much more firmer and more positive sentiment, the underlying correction may be more smaller, as there are still more people who probably can still and will come into the market as well. So these are the various variables that you have to bear in mind, I suppose, at the end of the day when you're looking at the property sector within Singapore itself. So basically, I suppose on that note, I should stop here because I think I've rant on too much already, and hope you guys have a good and productive day ahead as well as tomorrow as well. And if you remember, you need financing needs, IMB for whatever you so need as well. So on that note, thank you very much and have a good weekend.